Hey, this is Byron, and I want to talk about options trading. Okay, this is something I'm very good at. All my friends wanted me to talk about it, and family members. Now, options trading is not the same thing as day trading. It's a different scenario. Options trading, you are buying contracts. There's a difference. One contract is 100 shares. I'm going to show you on my board when I get a chance. Um, you have you have the option to buy a certain contract at a certain time. That's all you're doing. And when you look at the screen, say you get a brokerage account like E-Trade or Ameritrade or Charles Schwab, whatever, it gets intimidating when you see the screen. But there's certain things you only need to look at: the strike price, what the stock is selling at, and how much the premium is or how much the cost is. Or if you're doing a call or a put. A call is when you want the stock to go up. A put is when you want the stock to go down. I'm going to keep everything in layman's term, everything's simple for you. This is options trading I am training on right now. Okay? So that's basically the basis of it. You're buying contracts. Remember, one contract is 100 shares. One contract is 100 shares. I want to emphasize that right there. And that's what makes options so dangerous. I kind of recommend it to advanced traders, not beginners, because you can lose a lot of money real quick. I really mean that. Because you can buy more stock. Why buy 100 shares of something for $2,000? When it comes to options, you can buy that 100 shares for like $20 or $30. See what I mean? You have more capital. So you can buy, if one contract is 100 shares, you could probably buy unlimited amount of contracts. But that's what makes it so dangerous, because if that stock, I want to emphasize that, if that stock do not get to that strike price, it's a certain strike price you want to get to at a certain time period, you can lose so much money. And I have done that, trust me. And I'm not trading options right now, but last week I traded it. I made money because I have a gift and I know the trends of stocks. But remember, what the pressure that you put when it comes to options, there's a certain amount of pressure on you because there's a time period. You only have up to a certain amount of time to sell that stock to get into money. Follow what I'm saying? You only have a certain amount of time to get to a certain price to get into money. Because if you don't get to that price at that time frame, you lose money. As simple as that. Now let's go to the board. I'm going to show you a couple of examples because I'm watching my videos and so many people are making it so confusing. So I'm going to make it as simple as possible. This is options trading. Okay? Simple as that. Let's go to it. A couple of things you need to know. Let me lower the board for you. Let me get everything set for you. 1 second here. I'm getting everything set for you. All right. Okay. Turn my computer around. There you go. That's my screen. Now, you're trying to get to a certain strike price. Pictures in there? Yeah. You're trying to get to a certain strike price. Say Yelp stock. I'm using Yelp as a stock. Right now it's trading at $35 a share or $35 and some change. But say let's trade 36 to give you an example. This is an example right here. Say Yelp is trading at $36 a share. That's my fingers at. And in 30 days, you wanted to go up to 38. In 30 days, you want it to go up to 38. Okay? In 30 days. If that stock do not get to 38, you lose money. And one thing I was saying about a cost or a premium. See, say the cost is, because every strike price have different cost. Say the cost is 80 cents. That's why I wrote it down. 80 cents. Now, one thing about cost and strike price, the longer you want that stock to get to a certain destination, a certain price, the lesser the cost is, the lesser the premium is. That's something to remember. If you want that stock to get from 36 to 38 in 1 month, your cost is going to be very low. But if you want that stock to get from 36 to 38 in 1 week, that cost could be like $3 or $4. I'm sure it could go up a lot higher per share. Remember, one contract is 100 shares. I'm trying to emphasize that. Okay, now Yelp price. We just speculating here. Yelp price is at 36, and you want to get to 38 in 1 month. Okay, that gives you the option to buy it at 38. Now, say that stock Yelp gets to 38 exactly. That 30 days, your time is up. You have to sell that stock before or at that time. Say it gets to 38. Did you make money? No, you didn't, because the cost. You still have to pay for the cost right here. So you needed to get to, an example, you needed to get to like 30, 41 or 42, whatever. You know, you just want to get a little bit higher, or 39 or something like that. So you need a little cushion because you still got to pay for the cost or the premium. Some people say the premium, some people say the cost. That's just stock market talk. And this is basically what I'm talking about is stock options 101. Options 101, that's all I'm talking about here. There's a lot of more technical things that you need to know. But this is an example right here, this screen right here. It's at 36. You wanted to get to 38, say it gets to 42. You made $3.20 per share because you still have to pay that 80 cent per share cost or premium. See what I'm talking about? So just because it got to 38 or 39, that don't mean you made money yet. Well, 39 you did because you made like 20 cents, but that's nothing. 20 cents on 20 cents per dollar. Okay, the next thing I want to get to, and this is just an example here. Okay, strike price. First of all, the 38 is the strike price. It's selling at 36. 38 is the strike price. Strike price is giving you the options to buy at a predetermined date. You want 30 days or 1 week. And that's why you have to pay a cost or a premium, because they're allowing you to have the option to buy a certain stock at a predetermined date. And that costs you a little bit. Okay, contract. I told you, went over that right here. 100 shares. One contract is 100 shares. A premium is the total cost of the contract. That means the premium is you trying to get it to 38 plus the cost that they're charging you. Remember, one thing. Oh, I want to get my picture on the screen so bad. You are, where am I? Oh, come here. You are the buyer. Because we're doing a call, not a put. You are the buyer and you're selling to somebody else. Now I'm going to give you another scenario. Another scenario is, what if that stock gets to 37? It's selling at 36, but it goes to 37, not 38. That contract is worthless. You might as well buy it in the open market instead of for 38. You buy it in the open market for 37. You see what I'm saying? It gets very tricky. You don't buy it for 38. That contract is non-void. You don't use that contract anymore. You wait to get to the open market and you buy it for 37. See, you save money. See, there's a lot of scenarios like it's the stock is at 36. Perfect example. The stock is at 36 and it only gets to say 37. I told you about that. You don't want to use that contract. You just buy it in the open market. Now, if the stock goes from 36 in that 30-day period, it gets to 42. Listen to what I'm saying. It goes all the way to 42 in 30 days. You have a right. You have a right. Remember, you are the buyer. You have a right to buy that stock at 38, not at 42, because it's at 42. You have a right to buy it at 38, and you can sell it immediately at 42. You make a $3.20 gain per share. That's a lot of money. See, options is not like regular day trading. It's different. Remember, you are the buyer if you're doing a call and you sell it to somebody else. That's an example. Basically, options is giving you giving the investor insurance. That's why they charge you a premium. It's like you getting insurance on your car. Same thing. This is a perfect example. I recommend it to advanced traders. Now, let me go to. I'm going away from the screen here. Come back to this ugly face right here, because I'm getting into this. I'm getting motivated. Please like, subscribe, and share this video because I'm teaching about options. Please like, subscribe, and share this video because I am pumped up right now. Okay, options. I recommend it to advanced traders because beginning traders all of a sudden start buying all these contracts and they lose money because the pressure of having a time period. Some people get greedy, right? Some people get greedy. They say, let's use Yelp example. $36 a share. They say, ooh, Yelp been going up 7 points every month. Been going up 7 points. I wanted to go up to 43 in 1 week. So they want that money quick. People want that money quick. And it don't get to 43. But they buy like 5 contracts, 500 shares, and it don't get there. When it get to that 1 week and Yelp is not at your 42 where you expected it to get to, that contract is worthless. Say it's at 39. You might as well void that contract and just buy it on the open market for 39. You know how much money you lost if you had 5 contracts? That's what makes it so dangerous. People get greedy because they don't have to spend that much capital to get stocks. You're just using a small percentage of your money. But if the stock don't get there at that time period, do you know how much money is taken away from you? It's a lot of money. Now, we just talking about calls. Calls is when you want stocks to go up. Hold on one second here. And one more thing I want to emphasize. I'm good at this. When it comes to Ameritrade, E-Trade, Charles Schwab, when the screen pop up for options, when you try to invest using options trading, it could be intimidating. It's so many different numbers and stuff like that. Just look for the strike price. Just look for the time frame of how long you want to, that stock to get to that destination. Just look for the basic things, the strike price. If you're doing a call, look for the call. You look for the strike price, and you see how much they're charging you for the premium, and how much time period you think that stock is going to get to the number that's in your head. But give yourself a little cushion too. Say, this is a very expensive, helpful hint I'm about to tell you. Just because a stock been doing good, you expect the stock to go up in 1 week sometimes because the stock been going crazy, it's been going up like crazy. Give yourself a little cushion if you think that stock is going to go up. It might cost you, matter of fact, it's going to cost you less because the longer period of time you think that stock is going to get to your number, your destination, the lesser the premium is, the lesser the cost is, and you are giving yourself a little cushion because you're giving yourself a longer period of time for that stock to get to that destination, that time frame. I'm talking so much, I'm coughing. Don't get greedy. That's my favorite saying. Do not get greedy. Now, there's a lot of pressure on you because now, when you sign that contract, say Yelp again, it's at 36, and it goes up to 42 in 1 day. You have a right or option to sell that stock right away at 38, you have a right to sell it, to buy it at that 38 and sell it immediately at that 42. You could gain that money in the first day if you want. Options is very tricky, but first of all, the strike price and the time frame, that's the most pressure that is getting put on you. Okay, say it's at 36, Yelp's at 36. You sign a contract where you want that stock in 1 week to go up to 42. Now you have 1 week. See all that pressure? That stock has to go up to 42 because in that 1 week, before, you have to sell that stock regardless of what the price is. See the pressure? See, options is very difficult. Now I'm going to talk about puts. Puts is when you want a stock to go down when it comes to options. You want that stock to go down when you go to options. Let's use Yelp as an example again. It's at 36. And you want that stock to go down. You think that stock is going to go down to, say, 25 because the history of it has been going down and it's on a downtrend in 1 month. Okay? That stock, in 1 month, you have to sell that stock or before. If it reached that 25, guess what? You still have to sell that stock. See, with regular trading, you don't have no time frame. You can keep it for a year, 2 years. It don't matter. It don't matter when it comes to regular stock. But when it comes to options, there's always a time frame. Whatever you sign that contract for 1 week or 1 month, there's a time, and that stock has to be sold. If you lose money, you just lost money. That's what makes it so dangerous, the time frame. And it has to get to that goal or your goal by that time frame. I hope you follow me. Please leave comments. Please subscribe, like, and share this video because I'm going to talk about swing trading next. I'm going to talk about cryptocurrency. I'm going to talk about futures trading. I'm going to talk about any way that you can buy any type of stock. Well, I'm going to talk about everything. I'm going to teach you everything when it comes to all different types of stocks. I'm just getting started. Hold on 1 second here. I'll be right back with you. I want to make sure I ain't missed nothing. I got a whole board of, call, insurance, investor, invest, trader, strikes, got that. Okay, that's pretty much, I'm not going to talk your ear off, but I'm just giving you the basics of options trading. Remember, puts is the opposite of calls. Calls is when you want stocks to go up. Puts is when you expect stocks to go down. Now, you are the seller and you're selling to the buyer. It's a difference. Remember, the call, you are the buyer and you're selling to the seller. It's a difference. If you got any questions, please leave comments, and please, my email address is on there. I am really a professional at this. I cannot talk that well. I might be explaining things wrong, but I think I'm 99% right of what I'm saying because I get really motivated and really excited, and sometimes I mess up my words. But please, like I said, like, subscribe, and share this video. This is all about options trading. I hope I covered everything. If I missed anything, let me know, and I'll talk to you soon.